Hi all, welcome back to the class. Today we'll start with the basic terms of accounting. These are very important for you to understand to create a strong base when you go ahead with the accounting as a subject or you choose accounting as your career subject. So please be mindful and listen to all of these terms very carefully. Okay, so during this whole process of explaining the basic terms of accounting, I will take an example which is Mr. Mehta. So this is Mr. Mehta, okay, and he has invested the money to open a bookstore, stationery bookstore, which is called the Mehta bookstore. Then you have to be very clear in terms of getting this fact that Mehta and Mehta bookstore both are separate legal person just like you and me. We both are not the same person, or Mr. Mehta and Mehta bookstore, they are not the same person. They are separate person. They cannot be the same person. If Mr. Mehta is opening a grocery shop, the grocery shop and Mr. Mehta both are separate legal person. They have separate legal existence. They are just like you and me. Okay. Now moving on to the next topic or the term. Imagine you're like consider yourself as Mr. Mehta and consider you are opening a stationery shop. So what are the necessities to open a stationery shop? Uh, Firstly, you will need a normal chair, table, a fan, a basic almirah to keep your stationeries for selling. So all of these chair, table, fan, cooler, AC, whatever you'll need this, and those are not for the purpose of selling. Those are the basic necessities which are required for you to have it so that you can sell the stationery. Okay, so these things they are called the asset because they will provide future economic benefits. You are buying a table and chair for you to sit. You are not buying it for the purpose of selling. You are buying it for the purpose of sitting and selling stationery, not for the purpose of selling the chair and table. So all of these kind of things which you buy, which will be there for a longer period of time, they are called the asset. Okay, chair, table, a mattress, anything which is required in a shop, those are called the assets. Now coming to the next topic, which is goods. What are goods? Since you have opened a stationery shop, or Mr. Mehta has opened a stationery shop, he will sell stationeries. Stationeries, if I just tell or think of something, it's pen, pencil, books, notebooks. So any goods which is purchased or any item which is purchased for the purpose of selling in the store, those are called the goods. Okay, we very clear in differentiating between assets and goods. Assets are not for the purpose of sell. Goods are anything which is bought for the purpose of selling it in the normal course of your business. Now going back to the grocery example, if suppose Mr. Mehta has opened a grocery store, so in the grocery store the rice, grams, all of these are goods. Okay, so anything which is purchased for the purpose of selling, those are called the goods. Now coming to the next topic, which is liability. Liability means a promise to pay. There will be a promise to pay in future. Since I told you that Mr. Mehta and Mehta bookstore are separate person, so any amount which is taken by Mehta bookstore from an outsider or from Mr. Mehta will be a liability because Mehta bookstore has to pay back that money to Mr. Mehta or any outsider. Consider I am an outsider and I gave some money to Mehta bookstore. For Mehta bookstore, that is a liability because Mehta bookstore has to return back the money to me. Because Mehta bookstore and Preksha are both separate person. In the same way, Mehta bookstore and Mr. Mehta is separate person. So any amount which is given to Mehta bookstore will be returned back and hence considered a liability, which is a promise to pay something in future. Okay. Now coming back to the next topic, which are all basically related to goods, purchases, sales, revenue, expenses. Purchases. So any amount of goods which is purchased for sale is called purchases. Two things which you have to keep in mind is that purchases, it only includes the purchase of goods. Okay, and it has to be in cash or credit, not necessarily cash or not necessarily credit. It may be in cash or credit. The goods may be purchased in cash or credit. So amount of good which is purchased in cash or credit for sell is called purchases. Now sell, amount of goods sold or services provided in cash or credit by Mehta Bookstore is called sales. Okay. Now coming to revenue. So revenue and sales, they are similar, but revenue is a broader term. It's a broader term which not only includes the sale of goods or providing of services, but it also includes any other income which is made by the organization or Mehta Bookstore in this case. Suppose Mehta Bookstore has a lot of money in the form of cash. If it is depositing this amount of cash in the bank and the bank is paying interest, so that interest amounts to revenue. It's not sale, because sale is only sale of goods or providing of service. Generating of this extra income will be a part of revenue. Okay, so this is a broader term than sales. I have mentioned here that the interest earned by Mehta Bookstore for any money invested in the bank is called revenue. And revenue also includes sales. Now coming to the next term, which is expense. What do you mean by expense? The cost incurred or the amount paid in the process of earning the revenue, it is called the expense. Suppose you paid wages or you paid rent. So these are all the expenses which has to be incurred for earning the revenue. Because if you do not have a shop where you can sit and sell goods, where you can sit and sell basically, so you will not be able to earn the revenue. And for sitting in the shop, suppose you took the shop in the rent, you have to pay the rent. So this rent is an expense. Suppose you kept few of your staffs who will help you in selling the goods, so those are mandatory. So these expenses which are incurred and which help us to earn the revenue, they are called the expense. Now moving on to the next topic, which is expenditure. Again, like revenue and sales, expenditure and expenses are related, and again expenditure is a broader term. Okay, expenditure, it means the cost which is incurred to earn any benefit. To earn any benefit, if any expense is incurred, it is called expenditure. Expenditure is further divided into two parts, which is revenue expenditure and capital expenditure. So revenue expenditure is again called expenses. We have read in the previous slide expenses. Okay, this expenses is also called revenue expenditure. I'll tell you why it's called revenue expenditure. It is called revenue expenditure because the benefit of this is exhausted within a year. Suppose you paid rent, you paid month wise, and suppose you paid it for the month of January, the benefit of it is already taken up in the month of January. So the benefit is exhausted within a shorter period of time, which is 1 year. Okay, so those are called revenue expenditure. But what are capital expenditure? Capital expenditure are otherwise called assets, because we pay the money, buy the stuff, and we use it for a longer period of time, like the chair, table. We paid the money, so it's kind of an expenditure we incurred. But the benefit of it is derived for a longer period of time. So the chair and table which is bought by the Mehta bookstore will be utilized for more than a year. So it is called capital expenditure. So the benefit lasts for more than a year. It is called capital expenditure. Okay. Now coming to the next one, which is voucher. Voucher, as the name says, it's clear that it's a documentary evidence. Suppose you went to buy some goods from Mehta bookstore and Mehta bookstore gave a copy of whatever you purchased, like a bill. Bill basically is called voucher. Okay. Cash memo on payment of cash, invoice on purchase in credit, and receipt on payments are the examples of voucher. Any documentary evidence, they are called voucher. Because it's only on the basis of the voucher that you are able to maintain the accounting information. So voucher is important. Now, basic terms which are related to the sale of goods and purchase of goods. So profit. First one, profit. Profit in simple terms, it means the excess of revenue over expense. When your revenue exceeds your expense, it's called profit. What is loss? Loss is exactly the opposite. When the expenses exceeds your revenue, that is called loss. Now, profit and gain, they are not same. Profit and gain, they are different. When do you get profit? You get profit when there is an excess of revenue over expense. When do you have a gain? You have a gain when you get something not from your primary business but from your secondary business or from the incidental business. Okay, like you sold a chair, that was an asset which was purchased by you, and you found that it was getting rotten or wear and tear happened, and now you want to sell that chair because it's very old. Since you're selling this chair, you're getting some, you sold it in a profit, say. So this profit is called gain. But that is not your normal business. Your normal business is buying and selling of stationery. This is an incidental business or the secondary business. So any amount of profit which is generated not from the primary business is called gain. Okay. Loss, as I said you, excess of expense over income is termed as loss. Discount. Deduction in the selling price of goods is called discount. You very well know that when you go to buy something in the market, you ask for discount. So those are the discounts which are provided. So trade discount is provided on the marked price. You may get few questions wherein trade discount will come into picture. Hence, I have mentioned trade discount separately here. Now, the next one, financial year. What do you mean by the financial year? Financial year is the period for which the books of accounts are prepared. Okay. In India, we generally follow April to March as the financial year. In many organizations, you see Jan to December as the financial year or the accounting year. So what happens when you mean by financial year? It means only at the end of March you will be able to know your financial position. So for that whole period, at the end of that period, you will prepare your books of accounts, the final books of accounts, and then you will know your financial position. So that period is called the financial year. It is a period for which the books of accounts are prepared. Okay. What do you mean by stock in hand or closing stock? At the end of the year, considering the above financial year, March will be our end of the year. So April 2023 to March 2024. Consider that because it is 12 months. So April 2023 to March 2024. Any stock of pen, pencil, anything, any stock lying with Mehta bookstore at the end of March 2024 or March 31st, 2024 is called the closing stock. Okay. What is opening stock? Again, just the opposite, or as the name says, opening stock. Any stock which is lying with Mehta bookstore at the start of the year, which is like April 2023 or April 2024. At the start of the year, whatever is the stock is called opening stock. Okay. Hope I'm clear till here. We'll move on to the next one, which is debtor and creditor. These are very important. Debtor. Suppose I went to Mehta bookstore, I purchased some goods, pen, pencil, etc. And I had like 5,000 rupees to pay to Mehta bookstore, and I told that, okay, I don't have money right now. I'll pay it to you tomorrow. Since the money is not paid by me and Mehta bookstore is expected to receive the money, so I am a debtor for Mehta bookstore. Okay, because Mehta bookstore has to receive the money from me. That is called the debtor. I owe this amount to Mehta bookstore and hence I am debtor for Mehta bookstore. I have mentioned a separate example. Just you can replace my name with Mohan. That debtors are the persons who owe some amount to the enterprise or Mehta bookstore for buying goods and services in credit. Because I am not having cash, I said I'll give it to you the next day, which is credit. So here Mr. Mehta bookstore sold goods worth rupees 5,000 to Mr. Mohan, who promised to pay the amount later. So now Mr. Mohan owes 5,000 to Mehta bookstore. So Mohan will be termed as debtor for Mehta bookstore. Okay, so debtors being an asset because we have to receive the money. Mehta bookstore has to receive the money, so it is an asset for Mehta bookstore, and hence debtors are the assets. Now exactly the opposite of debtors are the creditors. Suppose Mehta bookstore went to buy some stock from its supplier. Okay, and Mehta bookstore, after getting those stuff from the supplier, said that I do not have the money right now, I'll pay the money to you later. Here Mr. Mehta bookstore owes the money to the supplier. Okay, in that case the supplier becomes a creditor. Okay, so creditors are the persons or entities who have to be paid some amount. In debtor, Mr. Mehta bookstore will receive the amount, but in the case of creditor, Mr. Mehta bookstore has to pay the amount for selling the goods or services. Suppose, for example, Mr. Mehta bookstore purchased books worth rupees 5,000 from Mr. Peter or the supplier and promised to pay the Peter on later date. Mr. Peter is owed 5,000 from Mehta bookstore. Okay, so Mehta bookstore promised I'll pay the money to you later. Since this is a promise, it's a liability, and for Mr. Mehta bookstore, Peter will be a liability or a creditor, and they will be shown in the liability side of the balance sheet. I'll come to the presentation of the balance sheet in a later stage. Since this is a part of the creditor, I have mentioned it that it will be shown in the liability side of the balance sheet. Note and keep in mind that the debtors and creditor, this term is used only in case of purchase and sale of goods or services. It is not used in terms of asset. Okay. Now coming to the next one, which is capitals and drawings. So any amount which is invested by Mehta bookstore, which is a liability again by Mr. Mehta, any amount invested by Mr. Mehta in the Mehta bookstore is called capital. Because Mr. Mehta and Mehta bookstore are separate legal person, the capital is also a liability because Mehta bookstore has to return the money back to Mr. Mehta. So any amount which is invested is called capital. And Mr. Mehta can invest in the form of cash or asset. And as I have mentioned that since both are separate legal entities, Mr. Mehta will receive the money back from Mr. Mehta from Mehta bookstore, and thus it is a liability for Mehta bookstore. Drawings. Drawings means any amounts or goods which is withdrawn by Mr. Mehta for personal use. Suppose Mr. Mehta wanted some stationery for his home. So any amount which is or any amount or good which is taken by Mr. Mehta for his personal use is called drawings. Thank you.